Right now, as you are watching this, Bitcoin just broke below $65,000 in early trading today, down 5% in the last 24 hours. And most people watching this are going to look at that number and feel something: fear, or maybe excitement, or maybe that familiar gut twist of not knowing whether to hold, add, or walk away from the screen entirely. But here is what I need you to understand before we get into anything else. The price is not the story. The price is never the story. The price is just the last thing that happens after everything important has already been decided somewhere else by someone else with a lot more Bitcoin than you and I combined. And right now, the on-chain data is telling a very specific story about exactly who those people are, what they are doing, and what that means for where this market goes next. I am going to walk you through all of it layer by layer so that by the end of this video, you understand the structure of what is actually happening in this market, not the hype, not the fear, the mechanics. Because once you see this, the price makes complete sense. Let's get into it. Here is the number that matters more than the price right now, 0.64. That is the Bitcoin exchange whale ratio as of this week, according to CryptoQuant, the highest reading since October 2015, over a decade. And if you do not know what that metric measures, this is the part you need to pay close attention to, because this single number explains almost everything about Bitcoin's current price behavior. The exchange whale ratio tracks the proportion of the top 10 inflows to total exchange inflows. In plain language, it measures how much of the Bitcoin currently being deposited onto exchanges is coming from the very largest wallets in the entire network. When this ratio is low, selling activity is spread across many wallets of different sizes. It is diffuse. It is organic. When this ratio is high, it means a small number of enormous wallets are responsible for the majority of Bitcoin entering exchanges. And Bitcoin enters exchanges for one primary reason: to be sold. At 0.64, CryptoQuant is saying that 64% of all Bitcoin exchange inflows right now are being made by the top 10 depositors by volume. That is not normal. That is not a healthy market distributing selling pressure evenly across participants. That is a concentrated, organized, systematic flow of large Bitcoin moving from cold storage onto trading platforms. And it is happening at a scale not seen in over 10 years. Now here's what this does not mean. This does not mean a crash is guaranteed tomorrow. It does not mean you need to panic. It does not mean Bitcoin is broken. The exchange whale ratio is a directional signal, not a countdown clock. What it tells us is that the composition of selling pressure has shifted dramatically. The people moving the most Bitcoin onto exchanges right now are not retail investors reacting to price swings. They are not small holders who got scared. They are entities that hold enormous positions, and they have made a decision to move supply toward liquidity. Understanding why they are doing that is the actual question. Let me give you the broader picture of exactly how much selling has happened, and then we will talk about what is behind it. CryptoQuant's latest weekly report shows that Bitcoin exchange deposits surged to around 60,000 BTC per day on February 6th, when Bitcoin briefly dropped toward the $60,000 level. That was the acute panic phase. Since then, the daily average has declined to approximately 23,000 BTC on a 7-day moving average. That sounds like improvement, and in one sense, it is. The raw volume of Bitcoin hitting exchanges has come down significantly from its peak, roughly 60%. But here is the nuance that most people are missing. The rate of inflow has dropped. The source of inflow has not changed. The composition has actually worsened. Because while smaller wallets have pulled back from exchange activity, the largest wallets have maintained their rate of deposits. They did not slow down when the panic eased. They kept right on going. And that is why the exchange whale ratio is sitting at a decade high, even as total volumes decline. The total flow is smaller, but the whales are a bigger and bigger fraction of what remains. Their selling is not reactive, it is structural. CryptoQuant also highlighted one specific actor in this flow. A wallet identified by analysts and referred to on-chain as Garrett Jin deposited nearly 10,000 Bitcoin onto Binance during this period. 10,000 Bitcoin. At current prices, that is $650 million in a single wallet movement toward exchange liquidity. One wallet. That is the scale of activity driving this ratio. That is what 0.64 actually means in real-world terms. Now let me add another layer to this, because the whale data alone does not capture everything. There is a second on-chain signal that runs parallel to the exchange whale ratio, and together they paint a much fuller picture of what this market is actually doing. Glassnode tracks what they call the accumulation trend score. It is a 0 to 1 scale that measures whether wallets across the network are broadly accumulating or distributing Bitcoin. A score near 1 means strong, widespread accumulation. A score near 0 means broad-based distribution. After the February 6th drop to $60,000, the accumulation trend score briefly spiked to around 0.43, up from readings that were close to 0.1 during the January breakdown. That is an improvement, but 0.43 is not accumulation. It is the absence of aggressive distribution. There is a meaningful difference between those two things. Glassnode is explicit about what is required for a durable recovery. They need to see that score move toward 1, specifically through large entity behavior. Small wallets accumulating does not move that score meaningfully. What moves it is the biggest cohorts of holders beginning to absorb supply rather than contribute to it. And right now, the data says those large entities are not there. Their conviction has not returned. The score is neutral, not bullish. Taken together, those two signals tell you the same thing from two different angles. Whale wallets are still net contributors of selling pressure, and the market's largest holders have not decided to accumulate with any conviction. That is the structural condition we are operating in. Not panic, not collapse, but sustained directional pressure from the biggest players in the network. Now let us talk about where the money to buy all of this selling is supposed to come from, because this is the part of the analysis that most channels skip, and it is arguably the most important data point in the entire current setup. Stablecoin inflows to exchanges are the fuel that powers Bitcoin rallies. When Tether, or USDC, is flowing into exchanges in large volumes, it means buyers are preparing to buy. They are staging purchasing power on platforms. That dry powder, as analysts call it, is what absorbs selling pressure and eventually reverses it into upward price movement. Without stablecoin inflows, there is no bid. Without a bid, selling pressure has nothing to push against, and price drifts lower. CryptoQuant's data on this is striking. In November of 2025, daily net USDT inflows into exchanges were running at $616 million. That was the peak. That was the fuel behind Bitcoin's run toward its all-time high of $126,000 in October. Now look at what has happened since. As of this week, daily net USDT inflows have compressed to just $27 million. That is a drop of more than 95%, and it gets worse. On January 25th, inflows actually turned negative by $469 million. That means stablecoin was flowing out of exchanges, not in. Buyers were pulling their purchasing power away from the market, not adding to it. Think about what that means mechanically. On one side, you have the exchange whale ratio at a decade high, telling you large holders are moving Bitcoin toward exchanges at an elevated and concentrated rate. On the other side, you have stablecoin inflows that have collapsed by 95% from their peak, telling you the buyers capable of absorbing that supply are largely absent. Supply is elevated, demand is suppressed. The arithmetic of that situation points in one direction. This is not a complicated signal. It is a fundamental supply and demand imbalance, and the on-chain data is measuring it in real time. Now let me add the third dimension to this picture, because we have not yet talked about the institutional layer. And the institutional layer is what was supposed to be Bitcoin's structural upgrade in this cycle. When spot Bitcoin ETFs launched in the United States in January of 2024, it was genuinely historic. For the first time, institutional investors could gain regulated Bitcoin exposure through familiar brokerage infrastructure, and the inflows were extraordinary. BlackRock's IBIT, Fidelity's FBTC, and the other approved products pulled in tens of billions of dollars in their first year. That institutional capital was a structural demand force unlike anything Bitcoin had experienced in prior cycles. It was systematic. It was daily. It was the bid that absorbed supply and underpinned Bitcoin's climb from $40,000 in early 2024 all the way to $126,000 by October. But something has changed, and this change matters more than almost anything else in the current setup. Spot Bitcoin ETFs have now recorded 5 consecutive weeks of net outflows as of the week ending February 20th, according to data from SoSoValue. 5 weeks in a row. The last time this happened was in February and March of 2025, when Trump's tariff announcement sent shockwaves through risk assets and triggered a comparable outflow streak that totaled roughly $5.4 billion. This current streak has already erased approximately $3.8 billion from the Bitcoin ETF complex. 5 weeks, $3.8 billion gone. To put that in perspective, BlackRock's IBIT shed $84 million in a single day on February 18th. Fidelity's FBTC lost $49 million in the same session. These are not small adjustments at the margin. These are meaningful redemptions by institutions that were previously the market's most consistent marginal buyers. And they are not buying the dip. That is the critical nuance here. In prior corrections during this cycle, ETF outflows were often followed by sharp inflows as institutional investors treated drawdowns as accumulation opportunities. That dynamic is not present right now. The institutions are not stepping up, they are stepping back. Glassnode quantified the scale of this precisely. U.S. spot Bitcoin ETF balances have dropped by approximately 100,000 Bitcoin since Bitcoin's all-time high in October. Total ETF holdings now stand near 1.26 million BTC. And perhaps most important for understanding the psychology of institutional holders right now, Glassnode estimates the average entry price for U.S. spot Bitcoin ETF investors is around $83,980 per Bitcoin. With the price now in the mid-60,000s, the average ETF investor is sitting on an unrealized loss of roughly 20%. That is not a position that generates confident buying. That is a position that generates patience and sometimes capitulation. Glassnode has defined the structural framework for this market very clearly. Bitcoin has broken below what they call the true market mean, which currently sits near $79,000. The true market mean tracks the aggregate cost basis of actively traded supply. When Bitcoin trades above it, the market is in an expansionary phase. When Bitcoin trades below it, as it does right now, the market has entered what Glassnode calls a compression phase. The lower boundary of this compression corridor is the realized price, which sits near $54,900. That is the average price at which all circulating Bitcoin last changed hands. It is the deepest structural floor. So here is the range Glassnode has defined for this market. $65,000, where we are trading right now, is in the middle of that corridor, below the expansionary signal at $79,000, above the structural floor at $54,900. What happens within this range is absorption. The market is not in free fall, but it is not recovering either. It is consolidating in a range historically associated with early to mid-bear market phases, and the data says it will remain there until one of two things happens. Either a decisive catalyst reclaims the true market mean, or a systemic shock pushes price toward the realized price floor. Glassnode noted something comparable happened in the first half of 2022, when Bitcoin was trapped between the true market mean and the realized price for months before the eventual capitulation to $15,000 later that year. That is not a prediction of where we go. That is a historical reference point for the kind of time horizon this range can sustain. Now let us talk about what is actually happening with short-term holders, because this group is the most vulnerable cohort in the current market, and their behavior is directly relevant to where price goes from here. Glassnode tracks what they call realized losses, meaning the actual dollar amount being crystallized by investors selling Bitcoin below their purchase price. At the peak of the February 6th drop, short-term holder realized losses were running at approximately $1.24 billion per day. People who bought Bitcoin relatively recently were selling at losses of over $1 billion per 24 hours. That is the signature of a panic phase. That is the market shaking out weak hands. Since then, realized losses have moderated to approximately $480 million per day. Still negative, still indicating that recent buyers as a group are selling below their entry prices, but at a much less acute rate. Glassnode describes the current phase as base building. The panic has cooled, but the losses have not stopped. And base building is not the same as recovery. It is a slow, grinding process where the market finds holders willing to absorb supply at current prices. That process takes time, and it does not generate upside momentum on its own. What does history tell us about setups like this? Because pattern recognition is one of the most valuable tools in market analysis, as long as it is framed with appropriate context and not used to make false certainty claims. The combination of an exchange whale ratio at decade highs, ETF outflows for 5 consecutive weeks, stablecoin inflows compressed by 95%, and the accumulation trend score stuck in neutral territory is a structural fingerprint. You do not see that fingerprint during bull markets. You do not see it during the early stages of recovery. You see it during extended distribution phases where large holders are systematically shifting supply to new hands, and the market grinds sideways to lower until either the distribution exhausts itself or a macro catalyst changes the environment. CryptoQuant's analyst referred to what has been happening throughout 2025 as the Great Redistribution. Bitcoin held by long-term holders was transferred to new owners in several waves across the cycle. Those new owners, many of whom bought through ETFs near the peak, are now sitting on losses. The long-term holders who distributed to them are the same cohort showing up in the exchange whale ratio data now. This is a cycle, and we are in the phase of that cycle where the redistribution is still running its course. The whale addresses confirm this directly. The count of addresses holding 1,000 Bitcoin or more dropped from 1,959 in late January to 1,939. 20 whale addresses disappeared from the data. That does not mean those holders sold everything. It means their balances crossed below the 1,000 BTC threshold as they distributed. Those 20 wallets did not disappear because of market chaos. They disappeared because of deliberate selling. They created the dip. They are not buying it. Now, I want to be clear about something important, because this analysis can easily be misread. None of this is certain. Markets do not move in straight lines. Distribution phases end. Whales reverse. Macro conditions shift. The data I have described to you is a probabilistic framework, not a guaranteed outcome. If you take one thing from everything I have said so far, let it be this. The structural conditions right now favor pressure on the downside. That does not mean up is impossible. It means the burden of proof for an upside move is high. The market needs evidence of change before that bias can shift. So what would change this picture? What would you need to see in the data to know that the structure is actually shifting? There are 3 specific signals that would tell you something real is changing. The first is the exchange whale ratio. Right now it is at 0.64, the highest since 2015. For distribution to be easing, you would need that ratio to begin declining meaningfully, ideally towards 0.5 and below. A falling whale ratio over a sustained period means the largest wallets are no longer the primary contributors to exchange inflows. That is the first signal that the selling structure is changing. The second signal is stablecoin inflows. Watch daily net USDT flows into exchanges. Right now they are at $27 million, down from $616 million at the peak. For buying power to return, you need to see that number begin recovering toward $100 million, then $200 million, consistently over several weeks. A single day of elevated stablecoin inflows is noise. 2 weeks of rising inflows is a signal. That is the dry powder re-entering the market. Without it, there is no structural bid to support a move higher. The third signal is the accumulation trend score from Glassnode. It is currently at approximately 0.43. For the market to shift from distribution to genuine accumulation, you need that score to begin moving toward 0.6 and then 0.7, sustained over multiple weeks. A single spike does not count. It has to be persistent. And it has to be driven by large wallets, not just retail activity. The score weight is specifically calibrated to give outsized influence to larger holdings. When you see it move consistently toward 1, the biggest players in the network have decided to accumulate. That is the market's most important green light. None of these 3 signals are currently confirmed. That is the honest answer. The whale ratio is at a decade high. Stablecoin inflows are near 0. The accumulation trend score is neutral. You can monitor all of these through CryptoQuant and Glassnode, both of which offer free tiers with access to these metrics. Now let me talk about the technical levels, because the on-chain picture and the price structure are telling the same story from different angles. Bitcoin is currently testing the $65,000 zone. This level is significant for 2 reasons. First, it aligns with a dense cluster of cost basis activity from 2024. Glassnode's UTXO realized price distribution shows a significant concentration of Bitcoin that was last moved in the 60,000 to 69,000 range, largely during the first half of 2024. These are holders who have been underwater, came back to break even, and are now watching price approach their entry levels again. When that happens, some sell, some hold. The density of that cluster is what has kept 65,000 as a relevant level. Second, and this matters for the risk framework going forward, below 65,000, the next meaningful support structure that most analysts and technical models converge on sits in the 60,000 to 62,000 range. Bitcoin touched this zone briefly on February 6th before bouncing. Every time a support level is tested, it absorbs some of the buying that was staged at that price. If 65,000 gives way with conviction, the path to 60,000 reopens, and 60,000 is a level that has already shown one crack this month. The resistance picture above current price is equally important to understand. Glassnode's data shows a massive overhead supply cluster between $82,000 and $97,000, representing cohorts of holders who bought in that range and are now sitting on significant unrealized losses. Every dollar Bitcoin moves toward those levels will encounter sellers who are relieved to be approaching break-even. That overhead supply is structural. It is not going away. And it means that even if Bitcoin begins recovering, the path upward is through a wall of supply that will need to be absorbed. 72,000 is the first level that most technical analysts are watching as an intermediate resistance. A confirmed break and hold above 72,000 would reduce immediate downside pressure. But above that, the true market mean at 79,000 is the real test. And above that, the supply clusters extend into the 90s. The mountain of overhead resistance is real, measured, and visible in the data. One more macro layer that is directly relevant to this setup. U.S. tariff policy has returned as a market pressure point. The Supreme Court recently struck down elements of President Trump's earlier tariff program. Trump subsequently announced a new global tariff of 10% on imports, later raised to 15%, the maximum allowed under the relevant statute. Risk assets responded negatively. Equity futures are down, led by a decline in NASDAQ futures. Gold is up 2%. Silver is up nearly 6%. These are classic risk-off moves, and Bitcoin is trading in correlation with the risk-off sentiment. Precious metals outperforming, equities under pressure, and Bitcoin sliding. That is not a coincidence. It is the market pricing uncertainty. This macro overlay matters because it affects the institutional behavior described earlier. Institutions managing diversified portfolios reduce exposure to high beta assets when macro uncertainty rises. Bitcoin, as Glassnode has noted, sits at the highest beta end of the risk spectrum. When tariff uncertainty is elevated and equity markets are under pressure, the institutional bid for Bitcoin through ETFs does not strengthen. It weakens further. The macro and the on-chain data are pointing in the same direction right now, and that alignment is worth taking seriously. So here is where all of this leaves us. Bitcoin at $65,000 is not a random number. It is the intersection of an on-chain distribution signal at decade highs, stablecoin buying power at near zero, 5 consecutive weeks of ETF outflows, an accumulation trend score stuck in neutral, and a macro environment that is actively discouraging institutional risk-taking. The market is not broken, but it is also not healing quickly. The signals that would indicate a structural shift are not yet present. Here is what to watch in the days and weeks ahead. Watch the $65,000 level closely. A sustained daily close below 65,000 opens the path toward the 60 to 62,000 range. That zone is important because it was defended once this month, and whether it holds again will tell you a lot about the conviction of buyers at those levels. Watch the exchange whale ratio. If it begins declining from 0.64 over the next 2 to 3 weeks, that is meaningful. It would indicate the largest sellers are stepping back. Watch stablecoin inflows. The recovery of daily net USDT flows from 27 million toward 100 million or above would be the earliest signal that buying power is returning to the market. And watch the accumulation trend score. If it moves from 0.43 toward 0.6 and stays there, the composition of market participants is beginning to shift in a more constructive direction. Until you see movement in those signals, the structural story of this market has not changed. Concentrated selling from the largest holders, absent buying power from stablecoin reserves, institutional redemption pressure from ETF outflows, and a Bitcoin price that is fighting to hold support inside a range defined by forces much larger than any individual participant. The market is still unfolding. The whales have not stopped. The stablecoin dry powder has not returned. The institutional flows have not reversed. These are facts from this week's data. They could change. Markets are not predictable in their timing, but they are readable in their structure. And the structure right now says patience is more valuable than action. Watch the levels, watch the flows. Let the data show you when the setup has changed, and when it does, you will see it before the price confirms it. That is the edge that on-chain analysis gives you. Not certainty, clarity, and right now the data is being very clear. If this breakdown gave you a different perspective on what is actually happening beneath Bitcoin's price right now, drop a comment below and tell me which of those 3 signals you are going to start tracking. I read every single one. Like this video, if the analysis added something to how you see this market. It helps more people find content that actually goes deeper than the price candles. And subscribe if you want this kind of structured, data-driven breakdown every time something important shifts in this market. This is what we do here. See you in the next one.